PayPal reported earnings and they beat nicely on EPS, reporting $1.20 per share instead of the $1.02 expected. And they missed slightly on revenue, reporting $7.85 billion versus the $7.89 expected. The earnings were very good with 9% year-over-year growth in total payment volume, revenue 6% year-over-year, transaction margins 8%, and free cash flow 31% growth, which is very positive. Another very positive aspect is that active accounts are growing again, which is very important because this was a metric that was decreasing in the past. Despite reporting good earnings, the stock price is not rising, mainly because of guidance, which was a bit soft with low single-digit growth and GAAP EPS between $1.03 per share and $1.07 per share expected for the next quarter. PayPal is a company with great fundamentals, as they have grown their revenue from $17 billion to $31 in the past 5 years. Net income has grown from $2.4 to $4.4 billion and free cash flow from $3.3 to $7 billion. They also have a fantastic balance sheet with $11 billion in cash and only 9 in debt. They have great margins with gross margin being 40%, profit margin 14%, and free cash flow margin 21%. Analysts are expecting them to keep growing and reach $37 billion and $5.51 per share in 3 years. If you assign a 20p to the company then, it would make it a $110 stock, meaning 38% returns. And they are selling for a forward PE of 17 and price to free cash flow of 11, which seems very cheap. In order to take a deeper look at the valuation, I used my Google sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value according to net income is between $67 per share and $150, and according to free cash flow between $95 and $192. And the stock is currently trading around $80 per share. It's higher according to free cash flow because I assumed a higher free cash flow margin, as it has been historically higher. Moreover, this means that if my low assumptions occur, you're going to make a 13.5% annual return on your money, middle 20.5%, and high 27.5%, according to free cash flow. And I think my assumptions are conservative, as I have the company growing 5% annual revenue growth on my low assumptions, 7% on my middle, and 9% on my high, a profit margin of 12, 15, and 18%, and free cash flow margin of 17, 20, and 23%. I assigned a 15, 17, and 19 PE at the end of the 7 years to the company, and assumed they buy back 2% of their shares annually for the next 7 years because they have been buying a ton of shares, and they guided for more share repurchase. As we have seen so far, the valuation looks very attractive and the fundamentals keep getting better. I have a position in PayPal and I am currently up 45%. I still believe this company is trading at a discount and this is why I'm not selling. However, I am not adding more at the moment as it is already a big position. But I believe this company still has a lot of upside. And even though the stock price is up 57% in the past year, it's still negative in the past 5 years. But remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know what you think about PayPal stock in the comments and I'll see you in the next one.